Hello everyone, I hope you all are doing great. So in this video, we are going to understand cost of equity in the simplest way possible, guys. Okay, so if you are learning WACC, DCF or valuation, then this concept is extremely important, guys. So by end of this video, you all will understand what is cost of equity, why cost of equity is important, and how to calculate cost of equity. So let's dive into the topic, guys. So your question is, what is cost of equity? So cost of equity is the return investors expect from investing in the company's share. Okay, for example, A is investing in a company AB Limited. All right, and why he is investing? For getting some return out of it, right? So that expected return is a cost of equity. Okay. Now we'll understand why cost of equity is important. Okay, so first is used in the WACC calculation. Okay, so cost of equity is used to calculate WACC. All right, in the previous video also I covered this part, right? So WACC basically tells us the overall cost of money for a company, right? So whether the money comes from debt or equity. Companies use WACC to decide whether a project or their investment is profitable or not. Okay. Another one is used in the company valuation. So cost of equity also helps in valuing a company. All right. So for example, if your investors want to know whether a company is overvalued, okay, or undervalued. Okay, so cost of equity plays an important role in deciding the fair value of the company or business, FB. Okay, another one is used in the investment decisions. So investors compare their expected returns. They are investing in different investments. Okay, so they are comparing their expected returns with the cost of equity. All right, so if expected returns are greater than cost of equity, okay, that is RE, then that is a good investment. It is good. Okay, and if the expected returns are less than their RE, then it is not good. It is a risky investment. All right, so cost of equity helps both companies and investors in making the smart financial decisions. All right, and even in the DCF model also, cost of equity plays a very important role. Cost of equity, basically in the DCF, we calculate the PV, right? Present values of the future cash flows. We have converted our future cash flows to the present value, discounted that, right? In the DCF valuation, you all know that, right? Yes. So cost of equity helps us to decide what discount rate to us. All right. So if cost of equity, which means if RE is high, then company is risky. Risk is there. Okay. And if RE is low or low, here high, okay, then company is less risky. All right, just ignore this handwriting, guys. Just try to understand the concept. Okay, so that is why this cost of equity concept is important. That is why cost of equity is important. All right, let's move forward. Now, formula of cost of equity. So we calculate cost of equity using CAPM model, guys. CAPM. Okay, yes. So cost of equity is equals to risk-free rate. Yeah, so risk-free rate plus beta bracket risk market return minus risk-free rate. Okay, this also can be written in this form. Risk-free is RF, beta we can write it down like this, and market return RN and RF here. All right, so where risk-free rate is the government bonds, okay, and beta we all know it's indicating the risk of the company, and market returns the stock market returns here. Okay, so now let's understand this concept with the help of an example. All right, so let's move forward, guys. So this is the example. So here risk-free rate is 6%, beta given here is 1.2, and market return is 12%. So here RF is 6%, beta is 1.2, and market return is 12%, right? So cost of equity, now what we need to do, we just need to put these values into our formula of RE, right? What is the formula? RF plus beta bracket RM minus RF, right? Yes. So here RF 6% plus beta 1.2 bracket 12% minus 6%. So here answer is 13.2%. Okay. So now we have done our this mathematical calculation. Now, what this 13.2 is indicating here? What it is representing? What's the conclusion out of this concept? Can anybody tell me? Just write it down in the comment section, guys. So I'll explain you all. Okay, so we calculated the cost of equity as 13.2%, right? So this means that investors expect at least 13%. So investor expecting here in this situation at least 13.2% return from the company for the risk they are taking, right? Whatever risk they are taking. So from that risk perspective point of views, they are at least expected this return. Okay, so now if the company earn more than 13.2, if the company is earning more than this 13.2, then investors become happy. All right, because they are getting more than their expected price. Okay, so that would be considered as a good investment. Yes or no, guys? Yes, this is considered as a good investment. Whereas on the other hand, if the company is earning less than 13.2%, guys, right? If they are earning less than 13.2%, now the investors are not really happy. Okay, and in this situation, this is not a good investment, or we can say it like this: investors may feel that the return is not enough for the risk. Okay, and they may prefer to invest somewhere else as well. They can also invest somewhere else. All right, so cost of equity act is like a benchmark. Okay, it act as a benchmark. All right, or the minimum expected return. Okay, yes. So in simple words, if I conclude this, so 13.2%, this 13.2%, guys, is the minimum return the company should generate to satisfy its shareholders. Okay, so if the company is earning more, so investors are happy, and if the company earn less, so investors may withdraw their investment as well. All right, so I hope, guys, you all understand the whole concept of this cost of equity. So in the next video, I'll be explaining you all about the concept of cost of debt. So stay tuned, guys. Thank you so much for watching this video. Do like, share, and subscribe, guys. And bye bye. Good luck.